Thank you guys for coming. We do this every single month. This is the first time that we've done it at our office. So thank you guys. This has been a labor of love for us. We spent a lot of time and effort getting this ready for VPG to have our headquarters here. We're not going to do all of our meetups here. Typically, we're at Port City Brewing, so there's alcohol involved. We did not get the permit to be able to serve you guys drinks, so sorry about that. We do have waters, Gatorades, and everything here. But today we're going to be talking about multifamily real estate investing, right? But before we get started, we always go around the room and say, who in here is doing real estate? So if you're a lender, raise your hand. All right, if you got money. If you're title, raise your hand. Who here is investing in short-term rentals? Short-term rentals. Who's here doing fix and flips? All right, who's doing small multifamily? Who wants to buy their first or next investment property, right? Or your primary residence, right? So as you can see, everybody in here is in different stages of their investing career, and we're not here to sell you anything. We want you to come here, and we want to be able to provide value for you so you can take the information and go outside and apply it. But most importantly, build the relationships with the people in here that are actively doing deals and are actively buying real estate and actively participating on a day-to-day basis. Build that connection and go outside, take the knowledge you learn from here and do deals with them, partner with them, lend money to them. That's the only way you're going to learn. You can't do it all by yourself. It takes an army. So let's learn about multifamily real estate investing cycles. So raise your hand again. Who here owns multifamily currently? Got it. So a few people will understand what these concepts are. We're going to show you and hopefully teach you what our process is. We have property management, construction, brokerage, all in-house. So we're fully vertically integrated. So we're able to buy these buildings and take them from point A to point Z interior, right inside of our network. But if you don't have everything, you still can do this. You just have to find partners that will help you get there. All right. So life cycle of multifamily investing. Who is BPG? I'm Cassidy Burns. I am the owner of BPG, but if everybody that's associated with us could raise their hand. So if you have questions about things that we do, reach out to these guys and lady. They'll be happy to help you. Everybody here has a different role. Richard, how's it going?
Hi.
Hey, come on in. Yeah. Come on in and grab a seat. Everybody's got a different role here, so they're all going to have expertise. So we're vertically integrated. We have brokerage, property management, construction and construction management, asset management and acquisitions. We're Class A RBC contractor in Virginia and DC, licensed property managers in DC and Virginia. We own $12.5 million in real estate. That includes this building that you're in here today. We bought this building in August. Have 242 units under management, which is our AUM is around $55 million total of the portfolio that we manage. So we're growing on a weekly basis, it seems. And again, it's because of everybody in this room. So let's talk about what our process is for multifamily. When we're evaluating deals, we do not buy it if we cannot check all 5 of these stages, right? And that is our strategy. Some people that are buying Class A buildings have a different strategy. Our strategy is 1, acquisition. So in the acquisition phase, we're touching on all the different phases of acquisition. We're going to talk about it. 2, we have to be able to add value. That's either by increasing rents, doing rehab through construction, or decreasing expenses in some way. 3, stabilization. This is going to be where we're going to get the building fully rented. This is the property management aspect of it. 4, disposition. Right, this is going to be getting and placing new debt, right? And there's 3 ways you can dispose. It's sell, refinance, or line of credit. We're going to talk to you with a case study of exactly what we've done. And then the thing that all of our LPs and investors are worried about, investor return of capital. Nobody wants to invest into real estate just to say they invested in real estate. In the end, it all comes down to dollars and cents that you guys are getting back in return. And if you're the one that's operating the building, and you're the one that's raising money, this is the question that you're going to have to answer. How are you going to get me my money back plus some? All right, we good there? We're going to talk about all 5 phases. So again, acquisition, value add, stabilize, disposition, investor return of capital. If it does not hit any of these metrics, we don't evaluate the deal, right? That's our philosophy. Cool. Acquisition. So, and I want this to be interactive too. I don't want to just speak at you guys. So when you guys are buying properties, what are you looking for? When you get something under contract, what's the things that you're going to do? Whether it's primary residence, multifamily, commercial, office, throw some things out for me. All the answers are up on the board, but I'd like you guys to interact. You're probably going to look at the negotiation of insurance. You're going to want to negotiate your lender. You're going to shop lenders and look for the best debt that you can get on the property. You're going to want to underwrite. What does underwriting have to do with? The rents, right? We have to know what that property is going to rent for now. And then what is our pro forma rent in the future, right? Due diligence, that's going to be inspections. That's going to be, if you're in big commercial, phase 1 environmental studies. And then closing. So when you're buying, and obviously the most important thing and the thing that most people have trouble with is the sourcing of the deal. If you're not in the business every single day, it's very, very hard to find really good deals just by looking at Zillow or just by looking at LoopNet, right? You have to have people, where's Peter? Raise your hand. That are actively sourcing deals on a daily basis. That is his job, is to find the best possible property. And then once you have it sourced, you touch on 2 through 4. And then the fun day, this is when you get to post on your social media, closed, right? But that is just the beginning. Because just because you bought the building doesn't mean we're going to get to phase 5, which is the return of capital. These next 3 phases are going to be the most important thing that you have to execute on. All right. So one thing that I didn't mention, and during the acquisition phase, and you guys, because nobody was interacting, is taxes, right? It's pretty important too. You need to know how much money you're going to keep when you buy these properties. So one thing that we always do, and if you would like a referral, we can connect you with this. This is a cost seg study that we did on the building, the case study that we're doing. So as you can see, who knows what a cost seg is? All right, Michael, give me what's a cost seg?
Accelerated depreciation.
Accelerated depreciation. So in commercial, in residential, how many years can you depreciate your building in your taxes? 27 and a half, I think is the 27 and a half. In commercial, how many years? It's up there. 39, right? Now, with a cost seg, 39 years on a building that's worth, the building here is worth $1,044,000. That's not very much money on an annualized basis, right? But what we did is we were able to depreciate all of the things, the personal property inside of the building. So we're able to take that $212,000 on an immediate basis on our tax. So we can pass that back to our investors on a K1. This is high level stuff. You should be doing this on every commercial building that you buy. And anybody that you're investing alongside should be doing these cost segs, because in the end, you want your checks to come in every single quarter, but on the K1, when you go to your taxes, you want it to show a loss, right? And this is how we do that for all of our investors. So commercial buildings, cost segs. Residential buildings, it really doesn't work unless you're doing short-term rentals, right? And you're depreciating drywall, flooring, refrigerators, all the fixtures. Non-structural stuff. Great. Here is what, again, just wanted to kind of show you guys and give you information. This is what the cost seg study, what they deemed the value of everything in this building. So appliances, this is a 17-unit building, just so, and we're the one we're going to touch on. They said we had 30,000 in appliances that we can immediately write off, 27,000 in cabinets, sinks 14,000, the floors were 92,000, and I'll give you a trick. We do this the day after we buy every single building. It's not after you renovate, because we want to be able to do it again. We want to be able to capture that depreciation again. So this building, we bought this in August. We immediately depreciated. We immediately did a cost seg. All the stuff that was in here, the old lamps, the old windows that we used, we were able to depreciate those immediately. Now, 3 to 5 years from now, we took all those write-offs, and now we're probably going to do it again and capture all the renovations that we're doing to this unit, and then also to the lower level and the first level too, right? So this is what they deemed. They send this to the IRS. They're the ones that back this. Cost segs, Very, very important in the commercial world. If they're not doing it, you need to ask them why they're not, right? Question?
Who's they?
Yeah.
How much does this cost?
Yes. So good questions. For each building for us, because we did 5 in 2024, was $7,500. Typically, it's around $12,000 to $15,000 per building. But because we did 5 buildings all at once, it was $7,500 per building. They is a cost seg third-party intermediary that we reach out to. This is not us internally doing this. We hire this out. They prepare the report, file it for us. We give it to our accountants, and then when we are going to issue our K-1s on March 15th, right, they're taking all of that into consideration and deducting that from their taxes.
Is there a seasoning period between the 2 cost segs after rehab?
They're going to look at, so they'll take photos on day 1. And then they'll take photos on for us, it's going to be month 36, right, or month 48. But if you put brand new flooring, they're going to depreciate that flooring. But if it's the same flooring, they will not depreciate it twice. You can only depreciate that asset to them one time. Makes sense? New appliance packages. So if you buy a 17-unit building, has all appliances, we depreciated $30,000, and then we spent $45,000 on it to renovate them. Year 3, we can write off that $45,000 that we spent on the appliances, or whatever they valued that appliances at that time. Okay. Good. Questions on that?
How long does it take for them to turn?
Each report was around 2 weeks, because they'll either come to the site or they'll want to do a video, and you have to supply photos to them. They're coming through and they're itemizing it, and you want to review it too. We wanted to make sure that because every little thing helps, right? But around 2 weeks it took for them to produce these reports. All right, cool. Value add, right? So this is what we're deciding to do during the due diligence phase of our acquisition. This is, all right, when we buy this building, what are we going to do to improve it? And that's either going to be, because our 2 main goals are what in commercial? I said it earlier. Increase income, decrease expenses, right? So you want to increase your income. So that's our rents, or you either increase the existing units, or maybe we can add units, and we'll talk about that too. Or we want to decrease our expenses. And that could be stuff as if we're efficient lighting on the exterior, or splitting the water utilities. So what is our scope of work that we decided in our due diligence phase? And this is where our value add and the rehab comes into play. So we own the building now. Now it's all right, we have our scope of work. Now let's go execute on the business plan that we told our investors, or that we said internally that we're going to do, to make sure that the value of the building is achieved to hit goal number 5, which is the return of capital, because that is the most important aspect of it. So we're going to show you a few videos of things that we've done, and I'll talk you through a few different value add strategies that we are doing. Next. Good. So we're going to go back to this case study. So this is 205 North Main. This is a 17-unit building in Harrisonburg, Virginia, that I bought in November of 2020, right? So a few things. Capital expenditures are your big items. They're the things that have to be done no matter what, right? Roof, HVAC, water, plumbing, electrical. So here's a picture of a roof that we redid. This cost us $12,000. We did this in-house. So we added and improved the building. When we go to get appraisals, we show them, hey, here's the money that we spent here. Here's one example of it. Next, here's a project. This was a storage closet. And we have a full, we'll bring you through the full phase of construction. The previous owner was using this essentially just to hold some of the security cameras, right? Security cameras and stuff. So we saw this as additional square footage, 600 square feet. So we converted it into another unit, right? Because in the end, increase income, decrease expenses. So as you can see, this is just the full phase of construction. It already had a water closet in there, so we just were able to add a shower. But you'd be surprised. So when you're going and walking these buildings, it's when you're building do your due diligence. What is the scope of work? There may be an office that they're using for property management. Maybe you're doing property management in-house, and you can convert that into a unit. Maybe there's an additional plot of land, and here's what it ended up turning out to be. Really nice. This rented for rented for around $1,000 a month additional, and at a 6 cap, that's $1,000 a month, 12, 6 cap. That's around $300,000 in value added to this building, and we spent around $35,000 in construction. That's a pretty good return on investment, right? And the bottom line is the cash flow increased by around $1,000 a month, right? Because in multifamily, increase income, decrease expenses, increases your net operating income, which then makes the building worth more, which then we can get into our disposition and our return of capital. Great. So questions on value add, on things that we're doing. I mean, there's so many things that you can do, guys. You can build new construction. You can build ADUs above the garage. That's a value add component. You can get in Washington, D.C., if you're buying small to mid-size multifamily, just getting the basement unit approved for a legal C of O converts it from a single family with an in-law suite to a duplex. That's a huge value add proponent that you can add value to the building through due diligence and some construction, right? If you're on a bigger, go ahead.
I was saying, what are your favorite value adds that are the lowest, basically the highest ROI, so the lowest cost but produce the most?
Yes.
Highest outsized rent, highest outsized.
Yep.
So,
Mismanagement of property. Mom and pop shops. So we love buying buildings that's, in this case, when we bought, and we'll show you the rent roll. This building, they were all rented for $600 a month. We knew the market at that time. I think my pro forma said like $775. So it was like, okay, we have $175 of just mismanagement that we can now take it in-house and get those rents to $775. Now those units are rented for upwards over $1,000 a month. But the lowest ROI, the highest ROI and the lowest dollar out of pocket is just getting the rents to market. In most cases, you don't even have to do renovations. Now, that's where understanding the asset that you're buying and understanding the market that you're buying in, right? If you're buying a property that the rents are at $2,300 a month, and the comps say $2,350, that's not a great value add strategy from a mismanagement. Maybe you have to add units, or maybe you have to convert a 1-bedroom into a 2-bedroom, and that touches on the next one. So utilizing square footage that's already existing is one of the best and easiest ways to add value to, right? So if you can take a 800 square foot 1-bedroom unit and throw up drywall, $2,000, put some electrical outlets in it and turn it into a 2-bedroom, 1-bath, you can very easily take that rent from, in this market, would be from $850 to $1,100 a month, right? That's a huge value add with very, very little down. Anything else? So many strategies that you can do for that, guys. You just have to have the business plan to execute on it. Cool. All right. Now, stabilization. This is the fun part. This is Mr. Alex Self. Yeah. This is property management, right? So this is, all right, we've added value to the building. We've added units. We have done the rehab to get them to where the market will accept them. Now we have to get tenants in. And not only tenants, we need to get well-qualified tenants that want to stay for a long time and will pay rent on time, right? We need to get this property stabilized, because in the end, when you're going to a bank, because to get to stage 4, disposition, the first thing they're gonna ask for, send us the rent roll. Send us the rent roll and send us your P&L. So don't go to a bank until you have the property fully stabilized. I would say around 90%, 90 to 95% occupied is a really good metric. If it's at 75, don't waste your time. Keep concentrating and beating the door down on the stabilization phase. Get those units rented out, get them rented out for market rate, and keep concentrating on decreasing your expenses too, right? So stabilization's not only about rents, it's also about bringing our utility bills down, right? So some things that we're doing now is we're implementing utility fees that are billed back to the tenants. So a lot of times with these mom and pop buildings, they will pay all the utilities. Water bill's in the owner's name, all the electric is in the owner's name, gas is in the owner's name, trash is in the owner's name. Sometimes they'll even pay for cable depending on the building. So the first thing we do during our due diligence is, okay, once we add that, we don't do this immediately either. We show them that we're adding value to the building. We'll paint the exterior. We'll give them a new roof. We'll do landscaping. We'll make the lighting better. So the tenants see, hey, these guys they're investing into the building. This building, we have done better signage and we've fixed the door. We are going to negotiate with these tenants to sign longer term leases, but we didn't do it day one. We're going to do it at a day 180, day 365, because we're showing the tenants that we're here to improve the place that they live. So you'll go in and then you add that utility fee. Hey guys, here's the average utility bill. We'll show it for you for the building for the last 3 months. Sometimes you can go and pay to have the water split. That's very, very expensive. Or maybe it's just, we're just going to bill everybody a fee back for $75 a month, right? 10 tenants at $750 a month in income, right? 100 tenants, $7,500. That's a huge, huge value add of income. It doesn't come off your balance sheet from an expense because you're still paying it, but at least you're increasing your income for when you have your rent roll and when you have your P&L to go to the bank. Good on property management, stabilization. This is the most important aspect of it all. If you don't have this, you won't be in business. You have to be able to manage tenants. You have to be able to have the hard conversations, and you have to be able to implement steady and consistent rent increases. What is our process right now of how we're contacting tenants?
Listens.
Like when they have a renewal coming up.
Oh, we reach out 90 days before, it's the new one, reach out again, 60 days, 30 days, let them know.
Yeah.
Potentially more.
Then we give them two to three options. Day 90, hey, your rent's going to be increased by X percentage. You can either do that, or if you don't respond, it's going to go to month at this percentage. You have to obviously know the legalities of the municipality that you're renting that property in, but we do it on day 90, day 60, day 30. We're very friendly. We're very nice. We're saying, hey, we want you to stay. We don't want to kick you out. But the reason we do is because our expenses go up. Who here has property and their insurance has gone up? Right? We have to bill that back to the tenants. That's not our responsibility to pay. Whose taxes have increased because the values of your buildings have increased? Right? You have to bill that back to the tenants, or you're going to have a business that's going to be losing money. Each property that you own is a business, and you have to operate it like that. All right? Cool. Very, very important. All right, so rent roll. So this is this building. Again, I wanted to show you the case study. Here's when we bought it. Total monthly income, $11,055. As you can see here with the average rents, we didn't average it out, but it was around, I think $660 was our average. Right now we are at $15,490. Right? And that is just from rent increases. As you can see, we're touching that $1,000 number. And our goal was to have all of these at that $1,000 plus. And most of these tenants haven't been turned over, right? That's it. But
yeah, the only ones that are actually at 1,000 are the ones that came vacant.
And we went in and we did
regular increases.
Yeah. Because we're also not going in of like these people. I'd say 40% of these people are still here in this bucket. We're not going up and say, hey, $1,000 a month, because that also is not fair to the tenants, right? If they're quality tenants, we want to keep them, and we're not trying to be greedy, but we are doing steady 3, 5, 7, 9% increases. But this just goes to show you, when we bought this building, this owner, I remember he was telling me, he's like, I don't believe that he's like, I don't really know why you're buying this. He's like, I don't really know why, because there's no way you're going to be able to get more rent. Mismanagement.
And on those $1,000 units, we get an extra $300 in application fees for people who just apply without even seeing it.
Yeah, because there's so much demand in this area. This building is in Harrisonburg, Virginia, James Madison University. I went to Bridgewater College. That's why we're buying there, because that is what we know and where we're from. And we love the market. We've been very, very lucky and fortunate to have these market to just continue to grow. But also we had the foresight to be able to say, hey, we believe that these rents are undervalued. But the key is consistency, 15,000, and then we're going to talk about disposition, because now stage 4 is disposition, right? So I need to go to, just so you guys can see, here is one of our P&Ls, some of the expenses that we have with multifamily buildings. We think this is always interesting. So you see late fees. We have a little income. This building does have laundry, so we collect around We collected $1,300 for the year in laundry, right? It's another income there. General maintenance, $2,200, landscaping, $200, cleanings of the common areas, $1,900. Next page. Property management fees. So we charge our own buildings property management fees, just so you know. And our total management fee, we only made $9,600 from a management perspective. This is why hiring professional property management is very important. We took the rent roll from $11,000 to $15,500. So that's $4,500 a month. And the property management fee was only $9,600. That's a pretty good return on investment from hiring a professional that understands how to actually execute that business plan. Key replacement, roof repair, like I said, costs $12,540. Utilities, water, electric. So that's a P&L that you'll see for a multifamily building, pretty standard there. This net, go to the next one. All right. This total building net operating income is $111,795. So we bought this building in November 2020 for 1.38. It just appraised at, they haven't given me the final number yet, but I know, and we'll talk about disposition, but it's over 2 million, right? So in 3.5 years, 4 years, we've made around $800,000 and added $800,000 in value to this building, right? That's going to be distributed to the ownership group, right? LPs and GPs, right? So around $800,000 value. Here's the building. These are all single flats. These are townhome style apartments on a really good street. All right, next one. Good. Disposition. So the disposition and return of capital can be done as one bucket, or they can be done in 2 buckets. In this case, we're doing it in 2 buckets. Mostly because we are going to hold this building forever, and we're going to continue to do cycles 1 through 4 continuously, right? Because we're going to have to add value eventually. In 10 years, those units are all going to be outdated. In 10 years, the siding is going to have to be replaced. So we're going to have to re-implement a new value add strategy to make sure that we're staying up with the market rents. So for this disposition, we talked about it. You guys remember what I said? What are the 3 ways you can dispose or do it and execute on a disposition? Sell, refi, line of credit, right? So I don't want to get rid of this building. I want to own this building. I want to give it to my children. So that sells out, right? So the 2 ways that I need to get my investors' capital back are either through a cash out refi or a line of credit. So how much did I buy it for? 1.38, so 1.4 million. How much is it worth now? 2.1, right? We'll find out hopefully today. It's supposed to be yesterday, but appraisals are always slow. So I had to get very creative with this capital stack. So this building currently we got a 20-year amortization schedule loan on it when I first acquired it with a 5.1 float. So if I bought it in 2020, what does that mean with the 5.1 float?
Time is now.
Time is now, right? Time is now. Now, is it a great time to refinance real estate? If I bought it in 2020, when do you think my rate was? My rate is 4% on this building, right? So this is a cash flow machine. Very low, cheap debt, low, cheap purchase price. We've increased the rent significantly. We are cash flowing a lot of money every single month after debt service and all the expenses. So my investors don't care. They want their money back because now they know, all right, the building is increased by $800,000, and also myself as well. I would like to get paid as well to make some money on this as well. Buildings appreciated by $800,000, but we have this tremendous debt until end of November of 2025. So I can either do a cash out refinance right now, right, and probably get into around a 7.25. That is going to be still better, still good, will still cash flow, but it's not ideal, right? So what we decided to do is I'm going to capitalize on the next 10 months of that 4.4% interest rate. So I negotiated with the bank that currently has this note. Hey, we have $800,000 in equity. Give me $350,000, line of credit, not a refinance. So they did the underwriting, they did the appraisal. That's how we know how much it's worth. We went to them and we locked in a rate at 6.7%. So now I have a line of credit at 6.7% for the next, we lined it up with the debt, and then we're going to go back to the market to dispose of it for the cash out refinance in November. Does that make sense? So we're keeping the original loan currently for the next 10 months. We're going to have this line of credit that's going to align with that first deed of trust line. This will be a second. We did have a few promissory note investors that were paying 7% on this one. So I'm paying them all off. So now I'm saving 0.3% on them, right? Because they were already getting the 7% pref every single month anyways. This was back when I had no clue what I was doing with the capital stacks, right? You learn how to raise money properly and how to actually do it. This one I raised 20% equity, so I own 80% of this building, and then I raised $40,000 of promissory notes at a 7% interest. Nobody in their right mind right now is going to give me $40,000 at a 7% promissory note. You should not do that, right? But those people did at that time, right? Because of the state of the markets, and it was a trust thing. So I'm paying them back all of their principal plus their interest. They've been getting the preferred return. We had already hit the pref of 8% for all of our LPs. They're getting 60%. So we're going to tap into, of the 350, we're going to tap into 170,000. We're going to pay back 60% of all the capital that our limited partners invested into the property. So now they're going to have a 40% equity stake. Tap into all, give them back, make sure all their prefs are hit, everything's hit, plus get them to 12%. And we're still going to have the line of credit, and we're going to not just use it. We're going to spend it to improve the building even more. So we're going to redo the decks. We're going to redo the awnings. We haven't talked about this, but that's how we're going to do this. We're going to redo the decks, awnings, and everything here to make sure when we go into November, it's going to be worth more than that $2.1 million, because now we've increased the building even more and we've recycled it. We've restabilized it because we were able to increase rents. We're going to put Trex decking on it to make it one of the nicer buildings in Harrisonburg. That's how much we believe in that. But that was the strategy here. Doesn't mean that that's the strategy for every single building. Just means that you have to have a business plan. And guess what? Back in the day, I was not thinking of opening up a line of credit. I had to get very, very creative and go to the markets and talk to the brokers and see what their appetite was for something like this. And I realized this is all part of being an asset manager, is the best thing for the investors and for this property is to not refinance at this particular moment. We're going to do that in the future once we've continued to add value. And that's another reason why I'm not touching all of the 350, because we know what it's going to appraise for. So I feel very comfortable with my preferred return at that particular time when we do a cash out refinance. Questions on that? Very complicated, a lot of different stuff going on.
Was the line of credit fixed rate?
Fixed rate 6.7%.
Because you negotiated that with the bank?
Yes, I negotiated with the bank, and I brought a bigger deposit to them for them to hold on. That's how I was able, because they were trying to get me at 7.25%, and I was gonna do it at another bank, but I went to the bank that holds the first, and I brought over our checking account over to them. It was like $70,000, and they're giving me a fixed rate on the 350.
And you can still refinance or cash out refi with the second.
So essentially what you do when you're looking at that is, let's just say I were to tap out the full 350. As soon as they give me the line, I tap it out. Our current loan amount on this building is $850. So that means that we'd be all in at $1.2 million. And I feel very, very comfortable at a 75% LTV when we do our cash out refi. Makes sense? I wouldn't do that unless I felt very, very comfortable with the loan to value on the back end of the refi. And we're not going to touch the full 350. I could return all my investors' capital the day we get that line of credit. And I've been very transparent with them. We're not doing it because we're not going to put the building at risk. We're going to hold this forever, right? You're going to get your money back in 4 months, right? So here's our business plan. This is how we're going to execute it. And I promise you we'll have your money back later. And that's the transparency is very, very important, right? Don't just say don't put your building and all the financials and all the hard work that you've done on the process at risk just to give them back their money for show, right? Good question.
It's a couple now, but, do you pay your LPs quarterly or annually, or is it all one sum at the review just closing?
Yeah, quarterly. Yeah. So LPs quarterly, but again, it depends on the deal. These promissory note people were paid monthly. So that was part of the agreement of that 40 grand. All the LPs in this deal are paid on a quarterly basis. Yeah. So you get four checks a year.
So when you refinance, do you know what your terms are gonna be?
So we're shopping right now.
Okay.
So we're actively, and I was shopping for about 4 months before I decided on the strategy. And actually a broker that I work with very closely in this market was the one that suggested this. He's like, you could do this. He's like, well, why don't you just go and start calling about lines of credit? You have the equity. And that was his suggestion. So I did that, and that actually has ended up being what we're doing. But yeah, as soon as we get that line of credit, we're going to be actively shopping with our brokers to different banks to see what their appetite is. And we're doing that with all of our buildings, all of our insurances, right? Austin, we talked about that. You should do this every single year, right? Because in the end, that P&L is very, very important. You shouldn't shop your loan every single year, but there's other things that you need to make sure that you're staying on top of. But yeah, it'll be a 6 to 9 month process of us talking to brokers to know and getting our terms for the cash out refinance in November.
When you do your cash out refi, are you gonna try to also pay off the second line of credit?
So they're aligned. So part of the negotiation with the bank is, I was like, I don't want a 2-year line because I'm going to refi you out anyway in November. You already know that we have that float. I'm going to refi, just align it with the current first deed, and we're going to roll them all up. Yeah, that's why the loan to value is very, very important. Understanding what the value of the building is on the exit. Luckily, we already have the appraisal. I'm going to pay to get it appraised again, because again, we're using some of the capital from the line of credit to improve the units even more and improve the building even more.
Cool.
Yeah, but it'll all be one first line, and then hopefully we'll be able to get enough excess to pay back all the remaining of the 40% plus some. And then again, now everybody has $0 in the deal, and it's just kicking off cash flow every single quarter. All those promissory note people will be out. Hopefully we're going to get them to reposition and want to invest back into our other deals, right, as an equity partner. But the equity people and individuals in this are going to just be getting checks with no money in it for the rest. And that's the whole purpose of this game, right? That's why you invest into deals like this, is once they're taken through cycle 1 through 5, now you own an asset, a percentage of these assets, of these companies essentially, right? Because this is an individual syndication. When you invest into a larger fund of some sort, you own the amount of units that you own that own the bigger portfolio of properties. Anything else? Cool. All right. Next one. This is the most important one. We kind of talked about this. This is our strategy. Investor return of capital. They're going to get 60% on the front end. Probably. I mean, we released all the promissory notes today because I got that. We released 48,000 today to the promissory note people, individuals, and then we're going to release the rest once we get that finalized line of credit, probably in the next 3 days, 3 to 5 days. I should be signed on the dotted line to be able to do that. So they'll get 60%, and then we're going to do a full cash out refinance, put long-term, hopefully agency debt, because it is fully stabilized. So we'll be able to get a 30 to 40 year term. This is a tertiary market. So agencies tends to, when I say agency, this is going to be, Freddie and Fannie, right? So they typically like primary and secondary markets. I don't know why this is a tertiary. To me, that's the value add in buying here because we believe that it's one of the highest growing populations in Virginia right now, but it is a tertiary, so you don't get the best terms in the agency. So we may have to go DSCR again. Cool. I don't know what's after this one. Sorry. Okay. Here's some of our portfolio. What questions do we have about the full process 1 through 5?
When you're stabilizing, do you normally try to do multi-year leases? Like, do you aim for that number? In this case, you're doing several rehabs.
Yes.
It doesn't make sense.
Well, it depends on the tenant. So if in this building, 100%. So we have in office, we have a 5-year lease on the first floor. We're trying to get a 3 to 5 year stabilized on the second floor, and then we have a lease signed on the third floor, so 3 years, right? With rent escalators. So every built into the lease, I think first floor is 2%, second floor is 3%, and then we have a 1% escalator on this unit. But in multifamily, I think it's better to keep it at 12 months, because if it's that undervalued, you want to be able to increase the rent every 3 to 5% every single year, right? When you lock in those longer term leases, you know, you're sometimes locked in at, and you're capping yourself of what the value could be of the rent. Now we do see in more valuable assets, larger single family houses, they like the stability of a 2 to 3 year lease, but they're not maximizing their capital stack. I know, Alex, you have something on this.
You can raise rents every 12 months, so if you're locking yourself into one rate for 24 months, your tenants go down on top of it.
Yeah. And typically when they lock in at a 2 year lease, and you always have tenants that'll say, oh, well, I promise 2 years, give me a discount. They always leave in month 12. Always. They will break it. So now you took less for that 12-month lease. Say, no, it's fine. We just would rather a 12-month lease, and then we'll renegotiate the lease at month 13. Or in our case, at month 9 is when we're starting renegotiating, because they're always going to leave. We've had multiple, and it's usually in single family houses too, is when they'll try to do that. So it depends on the asset class as well.
Do you always raise when you turn over leases?
We try, yes. For the longest time, let me show you. So this building, so this is one of my, it's a 4-unit building that I bought in 2017 in my hometown. I'm from Clifton Forge, Virginia. I bought it. We have one tenant in there that's paying $400 a month. And my mother does some of the property management on this building, and she loves the tenant. And she has the hardest time raising the rents. So it took us 4 years, and now finally Alex is the bad guy. But yes, we haven't, but guess what? Every year for those on this 4-unit building, my insurance increased, my taxes increased. I had to redo the back patios on them. You know, the roof eventually is going to need money. So you have to raise rents, and our justification is you have to raise rents to provide a good place for them to live. If you don't get the income, that's how slumlords are created. Because then they're going to be saving every single penny. And once something happens, you're like, I don't have the money to fix this because I had to pay for my insurance, my taxes, and I wanted to go to dinner, right? So you have to raise rents. I've done it where we haven't. It never works out, right? Be consistent. And again, that's kind of why you hire property managers. Let them be the bad guy. You're just the owner. I don't do the negotiating, right? The property manager is the one that you're talking to, right? In most cases, you don't even want the owners, the tenants to know that you own the building. Right. So yeah, so here's some of our portfolio that we've bought over the years. We manage right at, here's some of the buildings. Yes, we own right at 13 million. And then the stuff that we manage is worth around 52 to 55 million, depending on the basis. But this is some of the stuff that we do. Every building, if you guys want to buy this house, it is for sale. You may need to get a bulldozer to put it. It hasn't had a tenant in it for 2 years. All right, go ahead. Cool. Thank you guys for coming. Let's open it up for question Q&A. We do this every single month, and it's not always me up here jabbering. We bring different people of different trades, all in the real estate industry. Some really, really smart people, a lot smarter than me, that are doing a lot bigger business than me. And there's some huge value add in the stuff that we teach. But more importantly, it's about the people that you're meeting in this room, right? And hopefully going to do business with in the future. So whatever you take from here, make sure that you're connecting with the people that are here, and go and do business with them, right? Go to coffee, learn what they're good at, tell them what you're good at, collaborate, and see if you can go and make a deal, right? And make sure if you're going to do that, have all the paperwork done correctly too. Handshake deals are no longer a thing. So have the deals. What questions do we have? Anything? And then we'll open it up. We'll just do some network. I know I'm way over time. Yeah.
It's a quick question.
Yep.
So it looks like your portfolio is all in areas where it's a little bit less of a compressed cap rate than this here.
Yep. Yeah.
So I guess that's intentional. So, you know, how you find by added inventory that's closer to here versus out near?
Yeah. So we are actively submitting LOIs in this area as well. We're negotiating multiple small multifamily, some retail stuff, some office stuff. I think you just have to be very, very strict with your criteria. We like to, in terms of sourcing the deals, you need to be out there every single day doing it. That's what Peter and all of our guys are out every single day. So like, there's a reason that we're not transacting right now in this area. And it's because the deals are very few and far between. And I don't believe that there's much juice for the squeeze, right? It's going to be very hard to make money. So don't try to force something. That would be my big advice. If you want to just be patient. We've been very, very patient for the last 2 years. I feel like we haven't bought much. But right now we've got a lot of momentum on stuff that we're actually going to be able to execute and purchase. And it's all because we've been patient and building relationships. Don't force it.
Kind of a hot, irrelevant question. Are you seeing any change in market because of Doge?
I mean, that's so micro. We'll ask me Q3 to see if it actually affects. People were scared right now.
Yeah.
I mean, has anybody been affected by it job-wise in here?
My wife's contract got suspended.
Okay, so is she going to have a job?
She's on the beach. We'll see.
Yeah, right. So it's going to affect some people, but you have to. It's very unfortunate that it is, but there's going to be opportunity in that as well. I think that there's going to be opportunity in people's hardships, and that's just how this business is. Just if you're going to try to take advantage of them from a real estate perspective, make sure you're doing it morally and ethically will be the thing. But I don't know. Are people going to move out? I personally, if you guys want to know my 2 cents, I think that as the Doge is going to force some people out, the call back to office is going to force a lot of people back into the city. So I think that the people that bought in Leesburg, Reston, on the outskirts that are commuting 1 time a week, that are now going to be in the offices, they're going to all sell that inventory. So you're going to see a ton of inventory in the outskirts of Northern Virginia. And it's going to bring back office and condos and small multifamily and a lot of really good, well-qualified tenants that work in those office spaces. That's my philosophy on that. Now, I don't know how Doge they're going to leave and go to the beach, but in most cases, the government employees also have a spouse that works here in the city too, right? It's usually not 2 government employees that are together, right? There's somebody else has a job or an entrepreneurial type job, lawyer, attorney. So I don't know. We'll see, but that's my philosophy, is that I think that office and condos are going to do really, really well in the next 5 years in DC and the metro area. Anything else? Let's let you go.
I'm sorry. DC is a tenant friendly, right?
DC is very tenant friendly.
Any concerns with that, like as an investor?
Well, I mean, you need to, that's where going back to the stabilization phase. That's why property management is the most important aspect, and also the acquisition. So when you're buying in DC, right, there's something called TOPA, Tenant Occupied Purchase Act, right? So if you're buying, there are some loopholes that you have to jump through, and the seller has to jump through to make sure that a building, depending on the size, the type, the asset class, can be delivered to you to actually execute your business plan. But then on the stage 3, the stabilization, you have to place good tenants. And that's where the credit income verification, all of that comes into play. Be patient with, I'm talking about patience a lot. We're very, very patient. Be patient with that too. Make sure that you have everything with your tenants. You got a bad tenant, right? You got into a bad situation. Yeah, I can just see your face. I remember you talking. Yeah. But there are issues. It's very tenant friendly. In COVID, a lot of people got hurt. But of our 240 units, we only had 2 people that didn't pay because of COVID. Okay. It's because we worked with them, and then we were really good at the stabilization side of putting good people into the units. All right, I'm going to stop talking. I'm going to let you guys network. We're going to have some QR codes if you guys want to get in touch with us more and learn more about the stuff. And also scan this so you can get all of our meetups. Next month will probably be at Port City. I don't know which side. You got us kicked out of Port City. You know? Yeah. This is we got to play when you open up the beer and they tell you not to.
Yeah. Did they actually?
Yeah. 2 months in a row.
They called me.
Yeah. Anyways, guys, thanks for coming. Open networking. Hopefully this was helpful. Yeah, thanks, guys. Yeah, you didn't know that? Oh, they were pissed. Yeah, they were pissed. They were like,
Yeah, I live in the area.